Hello, fellow Robo Capitals. Hope you're well. So we've got some big news. I just discovered a report that came out that shows what the banks are doing with their balance sheet. And unfortunately, we haven't seen them do this since 2008, since Q1, in fact, of 2008. So let's dive into this report and try to figure out what this means, because unfortunately, it's rather opaque. You don't know exactly why they're doing it. You just know they're doing it. Let me show you what I'm referring to. So we go over to this report. Big shout out here. And I actually found this because Caitlin, what is Caitlin's last name? She's fantastic. She's a really smart gal that's doing the Bitcoin bank up in, I believe it's South Dakota. What's Caitlin's last name, Josh?
I don't know. I know who you're talking about, but I don't know her last name.
Yeah, let me give her a shout out here. Just look at my Twitter feed, Josh, and I think, well, I've got it right here. I don't want to pause the video here, but I want to give her a shout out. It's Caitlin Long, of course. I interviewed her a couple years ago. She's great. So anyway, she retweeted this the other day, and it goes back to June 20th, so maybe 3 weeks ago. And this is the Credit Bubble Bulletin, and chronicling history's greatest financial bubble. Okay. I think this guy or gal, I think we see eye to eye here. We're kindred spirits, that's for sure. But they broke down, I think, the Jerome Powell's statements, and then they go over some data from one of the Fed's most recent releases on what the banks, the broker dealers, are doing with their balance sheets. Okay, so let's I'm scrolling down. Last week highlighted. Okay, we got that. Here we go. This is where it starts. Let me zoom in for you guys so you can see it easier. Okay, that should be pretty easy for you guys to see right there. Josh, can you see that?
Yep.
Okay, broker dealer assets expanded by 490 billion, or 37.2% annualized during Q1 to 5.7 trillion. This was the strongest quarterly growth since Q1 of 2007, to the highest level since Q3 of 2008. Not exactly a great time for the banking system and the monetary system, was it? So again, just to make sure we're on the same page here. So we have the biggest percentage increase since Q1 2007. That in and of itself should give you a clue. And then we have, I believe, just nominal level, the highest since Q3 of 2008. And he said, George, I thought you were talking about Q1 of 2008. Well, that is correct, but we're going to get there in a moment. So this is just them expanding their assets. Now, I see a lot of people on Twitter that saw this and they're like, oh, wow, they're buying stocks, or, oh, that must be why the stock market's at all-time highs or something like that. I'm like, no, I don't think so. I think you might be missing the point here. More on that in just a moment. So for Q1, broker-dealer repo assets surged as quarterly record 230 billion, or 56% annualized, surpassing another great time in history. That would be the banking crisis, Q1 of 2023. You notice a similar theme here? So what I'm not saying is this is a warning. Well, I am saying this is a warning sign. I'm not saying that this is definitive proof we're going into a contraction or a risk off event or something like that. What I am saying is that during past risk off events that have been extremely serious, you see banks doing this. And we're going to get into the reasons why here in just a moment. So here's where we start to get into the Q1 2008. So broker dealer debt security holdings surged 145 billion, or 56% annualized. So again, when we see the assets expanding, we think that assets for us, it's wow, it's stocks, or they're buying gold or something. No, they're not. They're buying mostly treasuries, and I would assume mortgage-backed securities. But again, it's very opaque. What maturities are they buying? In fact, I talked to Jeff Snyder about this morning, and we're going to post that video on the Robo Capital's interviews channel tonight. So check that out. But as into the weeds as Jeff gets, he doesn't know exactly specifically what they're buying. But the debt securities, you can kind of rest assured that the majority here are going to be treasuries. So 145 billion, 56% annualized as far as the increase, surpassing Q1 of 2008's 1.1 trillion to a record 1.174 trillion. The debt securities were up 523 billion over 21 quarters. Wow, 82%. Geez. So okay, there's a lot going on here. Broker-dealer agency securities holdings ballooned 105 billion, 91% annually during Q1. Talk about Q1 of 2025 to an unprecedented 407 billion, and that's 255% year over year. Wow. Treasury holdings gained 33 billion Q1. Okay, excuse me. So I was under the assumption that debt securities were mostly treasuries, but it seems like they're not. So this is going to be mortgage-backed securities. It's going to be more collateral, basically. I'm actually surprised they didn't have more than 33 billion in the treasuries. But Snyder was saying it's very unclear. There's a lot of gray area. So the person that wrote this, fantastic job, by the way, but they might be guessing as to just how much of that 145 was 33, or excuse me, how much of the 145 was treasuries. They might be kind of giving an educated guess. Now let me read. Treasury holdings gained 33 billion during Q1. Okay. To year-over-year record 488. Got that. Treasury holdings ballooned 260. Oh, okay. So now it's going back different time frames. Got it. How did Wall Street finance such remarkable balance sheet expansion? What do you think? Repos, of course. So what's happening here, most likely, are the broker dealers are just going into repo and they're borrowing the money to buy the treasury. And so, or the mortgage-backed security, whatever it is, the collateral. And so you might be saying to yourself, whoa, time out, George. Isn't that backwards here? I thought a repo was it's a collateralized loan and it's collateralized by the treasury, let's say. So you have to have the treasury, you post that as collateral, and then you get the money. but you would be mistaken. What happens very often in the repo market is a bank or an entity starts with nothing. They don't have anything. They get the money and then they buy the collateral. And then the collateral stays on their balance sheet. They just kind of post it, and it never goes onto the balance sheet of the entity that is giving them the money to begin with. So that happens a lot, right? So these entities, assuming they're going into repo, that's how they could be doing it. They don't even have to have the cash to begin with. They borrow the cash first, and then they buy the collateral with the cash they just borrowed. You say, well, why would they do that? Because that collateral is still on their balance sheet. And what can they do with this collateral, especially if it's really, really good, such as treasuries, T-bills, etc.? The answer is they can lend it. They can rehypothecate it. And why would they do that? Because if stuff hits the fan, then they're going to have people, entities out there in the financial economy that are desperate for collateral. And they're willing to pay almost any price for that collateral. They're willing to take whatever haircut because it's their only option. So it's basically like buying credit default swaps. It's like buying insurance. It's like the movie The Big Short. That's the simplest way that I can put it. where they would go out there and they would basically buy insurance against these banks collapsing or against a financial crisis. So then and then they buy it for 2 cents or 5 cents or something like that. So then when the crisis happens, then there's a rush for that insurance. So what happens to the price? It goes from 5 cents up to $50 or whatever. And now that's an extreme, but I'm just using that as an example because everyone's seen that movie and everyone kind of gets how that works. That could be what the broker dealers are doing right here. Is they're basically buying something that they know is going to go up in price, or they're going to be able to make a lot of money by having that on their balance sheet and being able to lend that or rehypothecate it. They're buying that. They're front running. They're buying that in advance because they think the probability is increasing that this stuff does hit the fan. And if it does, they got what everyone needs and they're going to make out like bandits. And why not do it? Because you don't even have to have the money. You could just borrow the money in repo and then just keep that on your balance sheet. And then if stuff doesn't hit the fan, who cares? You're getting paid 4%. I mean, why would you not do this, right? Maybe you wouldn't buy a 10-year treasury because then the broker dealer would have that risk on there that if interest rates do go up and they have to sell it, now they got to sell it at a loss. But holy cow, why would you not buy T-bills? And this goes back to Scott Bessent, right? Because everyone was really hard on Janet Yellen, and I think she deserved a lot of it. But Trump, Scott Bessent himself, was critical of Janet Yellen for issuing so much at the front end of the curve. And everybody on Twitter always talks about, oh, well, they're doing, stealth yield curve control because they're issuing everything at the front end of the curve and they're not issuing anything at the long end of the curve because there's no bid at the long end of the curve. It's just pure nonsense. Pure nonsense. The reason they're issuing so much at the front end of the curve is because there's so much demand. And they know that's the collateral. And if there's not enough collateral, then they are risking a financial crisis, or they're risking exacerbating what would be a financial crisis, stuff hitting the fan, whatever you want to call it. That's why they're issuing so much at the front end of the curve. So let's see here. Now, I'm interested in this. I didn't see this before. Money market funds are largest holder of repos. Okay, got that. Money market assets rose. Okay, so they're this is great. This is great. You know what cracks me up about this stuff is when you read and when you understand about what these banksters are actually doing, and then you hear people in the financial media saying that like Basel III regulations are somehow going to constrain them. Are like really? I mean, these guys are as crooked as a scenic railway. You think that coming out or adjusting the SLR requirements or something like that is going to impact what they do? Come on. At the end of the quarter, they might have to I talked about window dressing today with Snyder. Yeah, sure, they might have to make it look pretty a little bit, but during the whole time, I mean, they're laughing at these regulations. It's just. So my point here is look at what they're doing. So the money market funds come in and are like, oh, okay, well, we'll give you a repo loan. Why not? And then what happens is the banksters are like, yeah, give me that money. And the money market funds are like, okay, well, as long as you give me a treasury to post as collateral. And they'll say, oh, yeah, we'll get to it. Don't worry about it. We got that collateral for you, but just give us the money up front. Okay, here's $10 billion. And then they take the 10 billion and then they, like I said, they buy the collateral with the 10 billion. And then they show, oh, here, Mr. Money Market Fund Manager guy, here we go. Here it is. And like, okay, thank you. And then they'll go ahead and take that. And don't worry, it's collateral. We don't pay you back, and you'll get those treasuries. Don't worry about it, right, Jim? Right, Jimmy? Right. So they're sitting there with their buddies, giving them the elbow and kind of looking, winking, and just jokes on the money market fund manager, because they know that if they don't pay, then good luck. Have fun with that. And why would it be difficult? Because they've taken that treasury and they've lent it out 14 times to other entities. So they go, oh yeah, sorry, Mr. Money Market Fund Manager, we can't pay you back. Like, oh, okay, can you give me that collateral? Well, actually, that might be a little bit of a problem because you see, right now it's on 14 other entities' balance sheets. Oh, and those are the guys that you think are following the rules. Those are the guys that you think are following Basel III. Come on, come on, come on, come on. As discussed in last week's Real Economy Sphere Financial Sphere Analysis. Yeah, exactly. Yeah, so what you have here, and I don't know if this is his point or her point, but this is just massive risk off because I don't know. I was trying to think of a scenario where this would be risk on. Like they would be doing this because they're like, yeah, the economy's jamming. Woohoo. Yeah, all these retail investors are piling in and options are at all-time highs. And there's this massive rampant speculation. And yeah, we're all in here. I was trying to think, and no, the three main scenarios that you have right here, and I know a lot of people thought this was due to SLR. Let's just assume that SLR or Basel III, whatever, had any teeth to begin with, fine, but they haven't adjusted those regulations. And what I'm talking about is they're considering adjusting the SLR to allow these banks to pile on the treasuries. But you see, they're doing that regardless. So I don't know why you'd have to adjust the SLR, but that hasn't been finalized yet. So this would not be a result of that. That's my point. I mean, I've seen people on Twitter suggest that this is because there's no bid for that's just complete and total nonsense. So really what you're left with are three different options that are the most probable, let's say. Because again, I can't get in these people's head. The only thing I can tell you is this is exactly what they did during 2008. This is exactly what they did during 2023 when Silicon Valley Bank went bust. And therefore, you have to connect the dots, so to speak. And you have to ask yourself, what are they positioning for? And then you have to figure out the incentives involved. And then you start, okay, I think I get it. So anyway, getting back to it here. Number one, we've got, I guess, what you would call an arbitrage. So, and another thing that I talked to Snyder about too, I should probably pull up a chart, but I don't have it right here. If we look at reverse repo, actually, let me do this. This is important here. So if we look at reverse repo, rate, excuse me. So I want the current rate is 4.25. That's right. Jeff told me that this morning. So you got to think about this. Right now, any one of these money market funds or anyone with cash can park that cash at the Fed for 4.25%. Anybody. Now, let me be clear. There's a lot of different entities involved here in the repo market, the financial institution. I'm just focusing on the dealers, the broker dealers, because this is what the article is about, right? But you have to think about, the pension funds, the money market funds. We talked about them. All these entities go into these interest rates. So anyway, getting back to repo, if you're one of these financial institutions that has cash, you can park it at the Fed and get 4.25%. Okay, pretty much. And this is how the Fed supposedly puts a floor on interest rates. Because why would you lend at 4% when you can get 4.25% from the Fed, completely risk-free? But what's interesting is if we look at, see, 4-week bill rates. Come on. So 4-week bill rate. It has gone back up slightly, hasn't it? Interesting. Interesting. So end of quarter, it dipped down to 4.08. Now, is this believe this. There's a couple different quotes on this, but we'll go with this one because even if the other one's a little bit lower, which I think it probably is, the other quote, it's all about the concept here. So you can see that it goes down to roughly 4.5% when reverse repo was 4.25. So in order to lend or buy one of these treasuries, you're taking a 20 basis point haircut. Now, why were they doing this? This is likely when the banks were loading up. Could they be doing it because of quarter end? Yeah, there's a lot of different possibilities here, a lot of different possibilities. But the bottom line is during this time, they're buying these 4-week treasuries instead of just lending that money to the Fed at 4.25%. Why would they be doing this? Well, one of the reasons, going back to what we were talking about here with the broker dealers, is they can take that 4-week bill, and if stuff really hits the fan, then they can go ahead and they can rehypothecate it. They can lend it out for others to use as collateral, and they're going to make more than the 25 basis points or the 20 basis points that they are effectively paying to hold that treasury, as opposed to just parking the cash in the reverse repo. If that was an entity, now the broker dealers probably aren't doing that because for them it's a little bit different equation, right? Assuming that they're using the cash that they're getting from the money market fund manager, assuming that they're doing that, they're probably paying 4.3 and then they're still buying. So that would be an even bigger spread, right? Because they're paying 4.3, but then they're buying at 4.05. So they're assuming, bottom line, that they're going to be able to make a lot more than the 20 or 25 basis points. Okay. So that would be the first reason. And the only reason that they're able to do that is if collateral becomes so scarce, or the need for collateral skyrockets. So what type of situation would we need to have in order for that to come to fruition? It's stuff hitting the fan, right? Stuff hitting the fan. Okay, so that's number one option. Now, I'm not saying that's what's going on. I'm saying that's what could be going on. Number two here would be they're just looking out 6 months down the road and they're saying, I mean, what are my options here? I can expand my balance sheet, try to make more money to do some stuff in the real economy, or maybe other things in the financial economy, but that requires more risk. I don't like that due to kind of what's happening with the economy, the data getting softer. And therefore, if I'm going to expand my balance sheet, I'd rather just do it in the safest way possible. That could be what's going on. But then I don't know why they would use so much repo. Like if they had the cash, then I can understand why they would buy the bills, but then why wouldn't they go into reverse repo? So kind of, although that's a possibility, I think my base case with the first two would be number one so far. Now, then the third one would be just capital appreciation. Let's say they're buying, longer dated treasuries. Then they're doing so because, again, they see some economic storm clouds. They see the data softening. They think the market's offside, the stock market. And they're just putting this on their balance sheet because they think it's a good bet. And, if interest rates go down, if the Fed drops rates when the market's not expecting it, like coming up in July, by the way, then they could get a capital gain. So my point is, I don't know which one of those scenarios it is. Again, I'm not in their head, but I know that all three of those scenarios is basically a bet on risk off. It's not a bet risk on. And then you have to match that up with other times in history when they did the exact same thing. And you have to understand now they've exceeded those levels. And I'm talking about Q1 and Q3 of 2008 and 2023, when Silicon Valley Bank blew up and we had such an issue with the regional banks, and the Fed basically had to step in and bail everyone out. So now, on that note, guys, I wanted to get you thinking. on that one. And I wanted to give you this information. I know it's rather esoteric, but that's why you guys watch this channel. I mean, you guys watch this channel for that type of intel that you're just not going to get anywhere else. I mean, you're not going to hear that on CNBC. And again, I want to give a huge shout out here to Caitlin Long. She's fantastic. And the Credit Bubble Bulletin. So that's creditbubblebulletin.blogspot.com. Okay. So now I want to get into tomorrow because it's a huge day. And this could be another thing that these banks are betting on. We have the CPI coming out tomorrow. So the month over month expectation is 0.3, year over year 2.7. We're going to see if this undershoots, like we've had a lot of the inflation data over the past few months, then this could change the probabilities the Fed pauses or drops rate. Right now, we're at a 95% chance they pause. And that's what the market is saying 15 days from now when they meet. So this is going to be, and I was talking to Jeff this morning, and he thinks if this comes in light tomorrow, as far as the inflation data, that this could go down like 50-50. Now, in his eyes, maybe not in the market's eyes. So last thing here I wanted to do is just shoot over to Mr. GPT here, Chat GPT. And so I took that blurb that we just went over from that person's blog post, and I put it into, this isn't even one of my GPTs. It's just kind of general questions here, as you can see. And I just asked ChatGPT, hey, why did they do this back in 2008? And I thought it was interesting that they basically came to the exact same conclusion here. So we've got liquidity hoarding ahead of a storm, we talked about, anticipating Fed easing or bailouts. Okay, that's stuff hitting the fan. Unwinding of risk assets. Okay, that's because they're seeing economic storm clouds. Regulatory and margin dynamics. So as risk models flagged deteriorating markets, internal risk controls force dealers to rebalance. Same exact thing. Okay, guys. So on that bombshell, I think the main takeaways here are we really have to pay attention to the data this week. Super, super important. That could dramatically change the odds of the Fed cutting or pausing in 15 days. And we do know definitively this is not a matter of opinion. This isn't fear mongering. This isn't, this isn't doom and gloom. It's just simply a statement of fact. These broker dealers are doing exactly what they did in 2008 and exactly what they did in 2023. And that is loading up on collateral that they could make a lot of money on if the stuff actually hits the fan. So I'm not saying that they're making this bet because I can't get inside their head. I'm not saying that's the highest probability. I don't know. You guys have to come to your own conclusions. The only thing I can do is present the information to you and explain it to the best of my ability so you guys can go ahead and include that in your analysis. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market, capitalism. See you in the next video.